Hey, welcome back. Um, what happens when the government tries to protect folks from debt, but, well, inadvertently pushes them into loans with near 16% interest rates?
Right. It is a tough situation.
Yeah, today we are digging into a stack of recent Korean financial reports. Our mission for this deep dive is to, unpack the complex realities of strict financial regulation and how it is reshaping the market for both consumers and institutions.
The underlying mechanics here are, really fascinating. When we look at the data from the Financial Supervisory Service, the shift in consumer behavior is immediate.
Yeah, the numbers are pretty striking.
Exactly. By the end of last year, small credit loans at 79 savings banks increased by about 20% to reach 1.3975 trillion won.
Wow.
Yeah, that is the highest level we have observed since 2008.
Okay, let's unpack. It's like squeezing a water balloon, right?
Yeah.
You restrict one end, and the water just bulges somewhere else.
That is exactly what is happening. The restriction driving this shift is the three-stage stress DSR rule. Because this regulation mandates a minimum 1.5% premium to interest rate calculations, traditional credit becomes harder to secure.
But wait, those strict limits do not apply to these small credit loans, do they?
Right, they do not. Loans capped between 3 to 5 million won are exempt. So vulnerable borrowers who are locked out of the main banking sector naturally flow into this unregulated space.
And man, those unregulated spaces are expensive. Bank of Korea data shows the average interest rate on these small credit loans hit 15.88% in February.
Yeah, nearly 16%. It is a heavy burden.
It really is. And the wealth generation from those high rates is not trickling down evenly either. I noticed that the top 5 savings banks accounted for 74.5% of the sector's total net profit.
Right.
So a few large institutions are absorbing the bulk of these returns, while the borrowers take on the heavy interest.
Yeah, but the friction is not just isolated to the consumer side. Financial institutions are simultaneously preparing for significant new regulatory costs of their own.
Oh, right, the voice phishing thing.
Exactly. There is a proposed revision to the Telecommunications Fraud Damage Refund Act. It is aimed at introducing a no-fault compensation system for voice phishing.
Meaning banks pay up even if they did not do anything wrong.
Yes. Under this framework, banks would have to compensate victims even without institutional fault. The Financial Services Commission estimates that with compensation capped at 50 million won per case, the annual burden on financial institutions could reach 281.1 billion won.
Okay, so what does this all mean for you, the everyday listener? Are banks just going to make transferring money incredibly difficult to avoid paying out?
Well, yeah, the banks are already signaling that stricter remittance processes will be necessary.
Uh-huh.
By shifting the burden of proof onto the institutions, the natural operational response is to, introduce friction into everyday transactions to mitigate that liability.
Wait, I am genuinely confused by how different institutions are handling these pressures, though. Take Shinhan Card, for example.
Right, their recent numbers.
Yeah, their net profit dropped 16.7% year over year to 476.7 billion won. Their CEO actually declared emergency management, and executives are returning bonuses to cut costs.
Which is a pretty drastic internal move.
Exactly. But then, at the exact same time, Woori Bank is launching an 18.4 trillion won emergency financial support program. How are two major players in the exact same economy reacting so oppositely?
It appears contradictory on the surface, I know, but it actually represents a dual strategy in Korean finance right now.
Okay, how so?
Well, Shinhan's response is an internal tightening measure, right? They are trying to address falling margins directly. Woori's strategy, which includes 13 trillion won specifically for new loans, is an external stabilization effort.
Oh, I see. Who are they targeting with those new loans?
They are targeting about 40,000 companies to help them weather supply chain and liquidity disruptions caused by Middle East instability.
Got it. So institutions are compressing internal costs while deploying capital to ensure the broader economic supply chain does not stall out.
Exactly. And, connecting all these threads leaves us with a pretty challenging thought about the future landscape.
What is that?
Well, as regulators try to build thicker safety nets, like the DSR lending limits and the no-fault phishing compensation, are they inadvertently making the everyday banking experience more expensive and restricted for the average consumer?
That's all for today's deep dive. We'll be back with more insights. You've been listening to the Korea Economy Brief, straight from the front page of Seoul Economic Daily. Thanks for tuning in.